Hey, good evening, everybody. Welcome out to tonight's training webinar. I'm Shade Foray. I would normally have Steve here with me, but he came into the office and got sick today, so he ended up going home. So we'll do the webinar here without him. I'm not sure if we have anybody that's here for the first time. I know we've got people that are joining on a regular basis, and so we get regular people, I think, that are new. We don't talk about a lot of the new stuff for people, like how to get started, and we wanted to do a little bit more to address that. I think aside from that, there's a lot of people that are in a way still new. They still want to get started. They're still in the middle of some of those steps, and so we wanted to address that tonight and talk a little bit about getting started. All of the webinars we do are recorded, so you can always catch the replay on the website. And also, questions are always encouraged. If you feel like asking any questions at any point, feel free to do that. I think it always makes the webinars more enjoyable, more interactive. So don't hesitate to ask if you have any kind of questions at all that come up. So let's first talk about just a couple of different things here. First, personal coaching is now going to be available, and in the past, Steve and I have done some personal coaching in the past, but it was something that we were a lot of times training people for, outsourcing. But what we're actually going to do now, we're finding more and more that we kind of like keeping things small, and so we're going to start doing personal training sessions with one of us. It'll basically be we're both going to be taking on individual members and working with them directly. So we'll have a page on that up tonight, tomorrow morning for that. If you're interested, you can certainly let us know. Also, the 3-day event, we are quickly selling out of that because actually we're doing it when you go to schedule these things. You can decide what type of place you want to do it in, and we're opting for smaller instead of larger, and so we basically have about 2 to 3 seats that are still available. And if there's anybody that's interested in going to that, let us know, because we'd like to fill the event up if possible to cover the event. So let us know if you have any interest in that, and we'll also be sending out some emails here this week. So yeah, this was a question that we got from one of the new members, and that is, just a new member basically saying, hey, I'm a new member, and I was wondering if you could tell me the best way to get started. And I think that everybody's in that position in one way or another. I mean, even after all these years, I think Steve and I, in a lot of ways, are still learning things all the time. And so I think it's important to address this for a minute, but we're also going to get into the steps to invest, just so we can get through, and I think help people that are looking to get started, actually get into that process. Now, part of this is, I think when you're looking to get started, everybody's kind of in the same situation where you want to gain any knowledge or information you need in order to invest. Okay, and I think the question is what is it that you need to know in order to invest, and how do you obtain that? Well, part of it's going to be book knowledge, and part of it is experienced knowledge. And I think it's important to recognize the two and to understand that there's going to be limits as to how much you can obtain or how much you can really learn on just either one side or the other. When it comes to book knowledge, we're talking about anything you can get your hands on in terms of training. So any of the content we have here with the programs, with webinars, different videos, anything you can learn there, all the way down to state laws. When it comes to the experience, these are the things that are going to be specific to counties. These are things that you really only learn by going through the process and of doing certain things, like attending the auction or dealing with county officials on things. Buying something in places is a learning process, certainly, and as you learn that process, it's easier to repeat the second time around. So let's talk about the things that the new members should do to kind of gain that information. We won't spend a ton of time on it, but then we're going to dig into just the steps of getting started. So what is it that every member should do to obtain that that book knowledge? Well, first off, if you haven't downloaded the home study course, we're going to tell you to do that first. You can also utilize the investor profiles and state profile systems. These are things that we're updating right now, but at the same time, though, still really helpful for people that want to get started and are not exactly sure what to do. In fact, we don't talk about a lot of these things very often, but specifically, you need to know exactly what your investment strategy is going to be, and it needs to be a strategy that's based on your resources and it's based on your objectives. There are so many different ways that you can invest, and it's important in the beginning to have a clear target in mind, to know exactly what it is that you're after. And I think that strategy really needs to include, when we say it needs to include your resources and your objectives, the strategy should be based on the money that you're working with and how you're going to take that money and turn it into more. And you're going to have different goals from somebody else. So I think that, that your strategy is going to be very personal to your situation and helping you achieve whatever your objectives are. So it's important to get that right, right off the bat. Other things you can do, though, once you're able to determine and know exactly what your strategy is, there are a lot of resources that are available to you. For instance, just Taxalist and the lists that we're using there, the way that you can link to different sales, online auctions, or over-the-counter lists. Utilizing the site, I think, is a big part of it as well. And then beyond that, once you're able to read the content, the training information that's there, and once you understand the principles that operate with tax liens and tax deeds, then it's a matter of starting the process of buying, which is really the process of attending sales, performing research on lists, contacting counties, etc. All these things are part of that experiential side of the training that you can only get really through doing. So, your primary resources, I would say, to gather that information, we're talking about the home study program, the weekly webinars, the training library with past trainings that we've had, and then just utilizing all of the different lists that are available and the way you can access lists on the website. That stuff is going to save you a ton of time. And we know that because in the beginning, I think what we spent the most time with in the beginning was trying to figure out what the heck we were doing and where we should go, what we were most interested in. And really, the way that it's all set up and structured is designed to help you do that. So, if you download the materials, the home study course is either going to be in 5 manuals or 3. It's really 5 manuals, but they've condensed some of the state guides down, so it's the same regardless of which one you have. But in the Quick Start Guide, there's a chapter that's dedicated to identifying your resources, helping you understand what your resources are, and then also a investor profiles chapter where it's going to outline many different ways that you can invest specifically. And if you can identify one of those profiles that seems to fit with you best, then you're going to have a list of states where that profile can be utilized. And the idea behind this is to try to narrow down your list, I guess, of places where you can potentially begin. The idea behind it is rather than looking at every state in the country and trying to figure out where you're going to begin, you can look through a list of states where the strategy that you want to utilize can be employed. And in doing so, you can start to learn about different states, because the fact is not all states are the same. Some states have laws that are more I think that are more beneficial to investors than other states. Some states have laws that almost hurt the investment. And so you're going to find that as you read about different states and how they operate. And this should also help you narrow down the selection to figure out which states you're mostly interested in. From there, you can start to narrow down into opportunities. Are there sales coming up there, or are there over-the-counter lists that are available? This is how I think this is one of the more effective ways to get started. We'll talk about it a little bit more, but let's first get into 5 different steps here to getting started, to investing. Okay, 5 different steps here to actually making a purchase. we've really been talking about step number one, selecting your strategy, but there's a lot of stuff that is tied up in just selecting your strategy. In other words, it implies that you already know a lot of things, like that you already kind of understand the content, that you've learned that you understand the principles behind how it works, and that you know what your strategy is. So, once you've got that strategy, it is a big part of the process here. What it's essentially going to do, though, is it's helping you to also determine where you can begin. And this is a question that we get with people sometimes. And really, from what we've found, I think there are two different ways that people can go about deciding a location. Either you're investing based on the location itself, so you know where you want to invest. It's a matter of finding the opportunities from there. Or you're looking at it the other way around, and that is that rather than having a specific location in the beginning here, you're looking based on the opportunities. And which direction you decide to go there will determine what you should really do next. If you already know where it is that you want to invest, then it's a matter of searching out the opportunities that are there. So if I know that I want to invest, let's say, in California, then I might even have a specific area in California that I want to invest. I might have a specific town, and there's nothing wrong with going about doing it that way. Let's say I decided I wanted to invest. We could say in a specific city there. Well, once I knew that, then I can go about the process of digging into the county website for that city resides in, and looking up what types of opportunities they have when they hold their sale. If they have any properties that are on the records now, like lands available, which a lot of counties are going to have. A lot of counties will have lands available lists within the county records that you can look up, and you can start there as a place because you know where it is you want to invest. If you're investing based on opportunity, then that's a matter of looking for sales that are coming up, and which states seem to offer some of the best opportunities. So, and really, I think what it's about is with your strategy. If anybody hasn't quite figured it out yet, when we're looking at objectives here, we're really talking about whether you want to acquire property or whether you want to earn a high interest rate return. And if you're into acquiring property, that also comes with other things. Obviously, there's greater risk when you're talking about acquiring property. There's also greater potential rewards. I think that the tax deeds are what we're looking at with acquiring property. They can be either short-term or long-term investment, but it's not necessarily easy. If you're looking for easy, then tax liens are going to be the way to go. They're more of a long-term investment, though. So it's different type of money oftentimes that's used to invest in these two. Long-term funds are generally used for tax liens, and it is very secure, very safe investment. You're going to earn a high rate of return. But again, you're not, that's pretty much what it's limited to. You have certain liens that you can foreclose on, possibly, but the vast majority of the time, tax liens redeem, and that's your objective when you're out there looking to buy liens, is to buy liens that are going to redeem, because those are the properties that are. I think those are always the best properties, and so. I think part of this is just determining with your resources and objectives what it is that you really want. If you need to make a ton of money with this and you're starting out with a small amount, then deeds are going to be the only way to really do that. You won't really be able to do that with liens. If you're trying to figure out a good way to invest your retirement funds better, then tax liens would definitely be a great way to go with that. They work perfectly for that kind of a thing. They're not going to take a ton of time, and it's very simple. You can sit back and collect checks in the mail. That's essentially what will happen when you're buying a lot of liens, or just constantly checks redeeming in the mail. But if again, there's not a lot of risk that's involved with that, because you're not actually buying the property. You're simply purchasing liens against the property, and the liens are going to be secured by it. So how secure the investment is really depends on your ability to choose liens that are placed against properties that have a lot of value, significant use and value, something that people want. So it's really, why don't we talk about, also something I did want to mention here. I think that the lists on the website are probably one of the most underused services or resources available. And it's a matter of becoming more familiar with how the lists are available and using it more. There are so many different types of lists that are on there, whether we're talking about the calendar, whether we're talking about the over-the-counter database, or just the links, direct links to the online auctions. That list center should be something that you use on a regular basis if you're looking for opportunities that are out there, because there are a ton of opportunities that are listed there within just that list center in that drop-down box. So with that being said, once you're able to obtain a list, the process from there is really about trying to narrow your selection to save the amount of time you have before you can really start performing a lot of due diligence. One of the first things that you're going to have to do is, in most lists anyway, is narrow your selection. And that's because you really don't want to waste time doing research on things that are not going to work for you. You need a faster system for eliminating larger lists, for going through lists quicker. And the best way to do that, the best way to narrow your selection, is using what we call the quick glance method. And we'll demonstrate it here as we look at some lists and how we use it. But the concept behind it is pretty simple. I think it follows just common sense. And the idea behind it is to take whatever information is available on the list that we can use as a criteria. The minimum bid amount, I think, is what we use most often because it's usually there, but every list is different. We're basically going to utilize the best information that we have on each list. So when it comes to the minimum bid amount, this one is oftentimes we end up bracketing and narrowing our selection anyway with something like a minimum bid, because we have a budget and because we're trying to invest within that budget. So we'll end up eliminating properties that don't really fit within that budget. So anything that's too expensive, we automatically know that we're going to eliminate that. But we can do so much more than that when it comes to our ability to kind of narrow our selection. We know that the minimum bid is going to be somewhat of a reflection of property value most of the time, okay? Because the amount you pay in property taxes is reflective of your property value, the amount of the lien in deed is oftentimes a reflection of property value. The only exception to that is if you have a situation where you're not dealing with apples to apples. Like for instance, if you think you're looking at liens that are all for a single year's worth of liens, and you happen to look at a lien that has multiple years worth of liens included in that group, then it throws it off. But for the most part, if you're looking at all of the new tax deeds, all those deeds were foreclosed on after a certain number of years there, and they're all going to be similar in that way, so you can take the opening bid amount to be reflective of the value. So basically, you can use that to narrow down your selection with whatever list you're working with. But you can also use something like whether or not it has an address available, whether or not it has, depending on the list. In some cases, a list may come out and provide something with us to tell us if there are improvements, and it will give us a assessed value on the property. And all these things make it even easier to narrow down that selection and to try to focus down. But your idea is to try to narrow it down to a handful of properties that you can perform more due diligence on. But we want to try to get that list down to a small number, and the idea behind this is to try to find those that are going to work best in the price range that we're looking at. So if we're looking at deeds and I'm in a set price range, let's say that I'm looking for single-family homes, it's really easy at that point to disqualify everything that doesn't meet that criteria. Okay, so I'm going to go and I'm going to look at the prices here, and I know that single-family homes are not going to be found below a set price. Now, it's going to be a range. It's going to vary from county to county, but let's say I've seen a lot of counties where you generally won't find a single-family home for less than about $7,000, you could say, or $5,000, you could say. The idea behind that is to start to ignore everything below that $5,000 mark and to find a kind of a sweet spot. And you may find that most of your single-family homes that you're going to be interested in are going to be found between an opening bid of $5,000 and $9,000. That's a really easy way to bracket your list down to just a handful of properties that are that are going to be best for what you're after. I think it's easy to let yourself waste a lot of time when it comes to lists. You want to do everything you can to save as much time as you possibly can when you're going through a list. So property addresses are another one that we use on a regular basis here, but it can really be just about anything depending on what the county provides. This is a different type of list right here, which one thing that's kind of nice about it is in the site address of this list, they would either give you a physical address on the property or they would give you kind of a rough description of what the property was. That was pretty handy, I think, when we were going through and scanning and trying to find certain properties we were interested in, but also having something like the land and the assessed value on the property also could be used. So the idea behind this is just to use whatever information you've got that is most effective so you can narrow down the number of properties you're potentially interested in. Bid to value ratio is something that we'll use pretty regularly to disqualify or qualify properties. So if we can look at and we can determine what a value is along with the minimum bid amount, that number right there will tell us whether or not we're interested in the property or not. But that's probably the fastest way that we have to narrow down our selection of potential things, just through a quick glance method. And the reason for that is because due diligence is the big time waster. That's the one that's going to take up the majority of your time. It's also the one you don't really want to screw up on. This is where the rubber meets the road, essentially. So let's talk about that for a second. Now, first up, is anybody here, do me a favor, if you're looking at buying liens, just type down in the question section or in the chat section liens. If it's deeds that you're after, type in deeds. I'm just kind of interested. We tend to get a mix, but I'm wondering what we have here and who's interested in what. The due diligence, oh, excellent. Both, there really are some advantages to both, and I've found that it's good to not get too much of a prejudice against one or the other, and that's just because you can find good opportunities with both, and they're really kind of different sides of the same coin. All right. When it comes to tax liens, the due diligence necessary is quite a bit less than the due diligence we're going to be looking at for tax deeds. And the reason for that is because of the nature of the risk that we're under, and also the potential rewards that are there. Let's talk about exactly what's important when it comes to liens, because when we're doing due diligence on tax liens, the reality is we can go through and do that within a matter of minutes in most cases. In fact, a lot of liens that we'll look at, we can decide whether or not we're going to buy them at a glance almost. And in some tax sales, you really have to do that. I've participated in tax sales before where they used a random selection or a rotational bidding method when it came to buying the liens. Those systems are awesome when you're attending smaller auctions because you're not competitively bidding down the interest rate, and you're not going to competitively bid up the cost of the lien. But the downside to it is that you can't select you can't just choose which lien it is that you want all the time. In some cases, they'd go through rotational bidding, and when your lien came up, you basically had to say yes or no on whether or not you wanted it. And a lot of people didn't really like that, but with liens, it actually works out okay. In other cases, when they do random selection, again, you don't get the chance to choose. They're just basically going to come up with the lien and give you the opportunity to say yes or no on whether or not you want to buy it. the first times I did that, I thought that was crazy, because in my head I was thinking, how do I perform due diligence? How am I supposed to know if this is good or not? Just right there as they pick it. And what I didn't realize at the time was that they knew that nearly all of these things were going to redeem and that they were all good investments. I was under the impression back then that to pick out a good lien was going to take a lot of work, that it was like choosing good properties. And the reality of it is, it's just not. Choosing good liens is incredibly easy, and later on here in the training I'll show you exactly how easy it is, because our objectives are just so much different. With tax deeds, the objective is your normal real estate strategy of buy low, sell high. With liens, our objective is different. With liens, we're after that high interest rate return. If it's a property we're after, we're going to be better off going to deeds. We're after that high interest rate return that we can make safely. And so we're really after the liens that are most likely to redeem. We're really after the liens that people want, or that are the most desirable property, something that somebody doesn't want to lose to foreclosure. So when it comes to tax liens, what are some of the things that we're looking at or that we ask? The first is, does the property have both use and value? That's something that you'll hear us mention on a regular basis when it comes to liens, but we want the property that the lien has been placed against to have what we would say is significant value. And what significant value really is enough value that somebody doesn't want to lose it to foreclosure. The only times when you can really run into problems with tax liens is if you're buying liens against properties that people don't want to keep. And the reason why that's a problem is because it messes up the system. You're basically relying on the property owner redeeming the property when you buy a lien. And if somebody doesn't want the property, so let's say that, oh, sorry, I was reading the question here for a second. If let's say we're looking at a tax lien, and what we're really trying to determine here is if somebody has let's say the tax lien's on a small piece of property, some kind of a leftover piece of property, not big enough to build something on, one of those extra pieces of land like we see all the time. The problem you could run into with a property like that is if somebody doesn't have the need for it, if they don't necessarily care if they lose it, because if that's the case, then you'll go through the redemption period. They're not going to redeem it, and after that, you'll have to go through the foreclosure process if you want to try to pursue something with it. But even then, if they don't care to pay, then the repercussions are you could foreclose on the property, but it's only going to be worth foreclosing on if you could sell it. So it's not worth foreclosing on a property that doesn't have any real-world value, that somebody's not actually going to pay something for. Even those properties oftentimes redeem, but you don't really have any way to come back at that if somebody doesn't want the property. Your only option, in that case, is to be able to foreclose on the property. So we want properties that would be worth foreclosing on if that were a possibility here. So the primary things that we want to know when it comes to a lien is if we can say, yeah, the property has use and value, then that's almost all the information that I would need. But the other thing I would want to know is what's the bid to value ratio on it. When we're talking about bid to value ratios on a lien, we could be talking about something as small as 1% or 2%. It may be up as high as, in some cases, I've seen maybe 8 to 10% in some cases, but not normally. Normally, it's going to be less than that. Normally, with liens, we're looking at a bid to value ratio that is a couple percent. Okay, and if I see a bid to value ratio that is a couple percent, I'm not worried. In fact, if I see a bid to value ratio that's even 10% on a lien, I'm not going to be worried. Now, if you start to get much above that, then I think you have to start asking questions because there has to be something wrong. If the bid to value ratio on a lien is much above that, then you're really going to want to start to dig into it. But the other important question, and probably the most important question to ask, is what's the roll-up on the property? And the roll-up on the property is essentially what it's going to cost you to foreclose on it if the property owner doesn't redeem. The roll-up can be the total amount owed in delinquent taxes. Think about this for just a second. One of the benefits of tax liens, or one of the powers they have, is they prevent the transfer of ownership. And that's going to be true of every tax lien that's placed against a property, even if it was not necessarily one that you bought. In order to foreclose on a property, even after the redemption period is expired, you're going to have to pay off any other liens that are outstanding on that property before you can foreclose on it. And so the roll-up we're talking about here is what's owed total on the property in terms of liens in order for you to foreclose on it. You want to know what that number is because that represents the total cost to foreclose. And you want to make sure if you're going to foreclose on this property that it's worth foreclosing on. So if it's $5,000 to foreclose on a property that's worth $10,000, then you would want to look at that because obviously it's a 50% acquisition cost there, which is going to be too high. You can find better deals than that out there. If you're looking at a roll-up of $2,000 or $3,000 on a property that's worth $30,000, then it's a different story, and the roll-up on that lien would be worth it. So, aside from making sure that the roll-up is okay, there aren't too many things that we're really that worried about. And if you're ever concerned about buying the right types of liens, and you can choose any type of lien you want, then you can make it really easy on yourself and select properties that have a lot of value. A property that has an assessed value of $100,000 is not going to be foreclosed on. At least rarely ever is something like that actually end up going to foreclosure. They almost always redeem because nobody's crazy. Nobody wants to lose their property to foreclosure. Oh wow, so I'm just reading one of the comments here. And it's interesting. One of our members looks like they attended an auction in Johnson County, Iowa, and each license was $100. It sounds like they were doing a random selection there, and that they basically your number only came up twice. Oh, I see what you're saying there. So one came up. That is one of the problems when you're doing some type of random selection, is that sometimes the amounts. The student was saying that one of the numbers that came up was a big $17,000 one that was outside, I think, of what they wanted to spend, and the second one was in a better price range, and they ended up buying it. But that's the other problem. It's not really being able to choose liens based on the price range. But what I would also tell everybody is that when it comes to buying liens, if you haven't bought anything yet, it's worth it to buy a cheap lien anyway, because you're going to learn that experience-based training is invaluable, and you're going to learn more buying that inexpensive lien. You'll gain more in value with that, just with what you'll learn than with what it will cost you by far. I think it's certainly worth it to go through the process of buying things. And that same thing can be said for whether you're attending an auction or whether you're buying over the counter, because the process of buying itself is unique to each place. And I think it's going to be a lot easier to do it the second time around once you can get through it that first time. Even when you go from county to county, you're going to end up going through the experience all over again. But the real value, though, is in re-attending auctions you've already been to before. In fact, I can't emphasize that enough. That where a lot of people have success with tax sales is by, it's the second time around that they attend, the third time around that they attend the same tax sale, because they understand the process that much better, and because, I think that first time around when everything is new, you can't help but for that to be somewhat scary, because it's new. because it's fear of the unknown, and because you're doing it for the first time. It's not scary, the second time around, the third time around, and that's really where you can have some of the most success as an investor. But getting through that first time is the challenge. So with liens, primarily, we just want to make sure that they have significant value, use that somebody wants to keep them. We want to make sure the bid to value ratio is not up too high, and that the roll-up is a reasonable amount. We want to know how much it's actually going to cost if we had to foreclose on the property. And as long as that number makes sense to us, then it's a good thing to buy. You just don't want to, I think what we're trying to avoid is buying the lien and having the redemption period expire and going to foreclose on it and saying, oh no, there's how much due in order to buy this? Let's say you buy a lien for $1,000 and you find out there are 4 or 5 other liens that are out there. That's the situation you want to avoid. And you can generally tell, well, I guess sometimes you can tell on the county list, but not always, from the list you're working off of, whether it's a first position lien or whether there's multiple liens against the same property. It's always worth taking a minute to use the parcel number and pull up the county records so that you can take a look and see how many liens are outstanding on a particular property. Now, if we're talking about tax deed due diligence, we've got a huge list of things or concerns we'd have. Lots of stuff we need to know. We want to know what the bid to value ratio is. We need to know what our exit strategy is with the property. We need to know what we estimate the value of the property under that exit strategy to be, because all these things are going to help us determine our maximum bid amount. We want to know if there are any potential liens that could still exist against the property. By the way, something that I just thought about here that's come up some, but a pre-auction investment strategy with tax sales. We've mentioned it in some of our materials before, and in fact, it is something that occurs in sales. There are investors that will put deals together before the sale, but it's similar to a pre-foreclosure strategy. We've been asked about that several times lately. About pre-foreclosures, basically with tax sales, and it's something that we don't generally pursue. And the reason why we don't generally pursue pre-foreclosures with tax sales is because we rely on that judicial foreclosure that properties go through, before they're offered up at a tax deed sale. That foreclosure is actually our best friend. That is part of what gives the investment so much power, is that foreclosure, and it's because it wipes out or extinguishes nearly any type of lien or encumbrance attached to the property. The only type of encumbrance or lien that it's not going to wipe out is another government lien. So that could be something like a municipal lien that could be placed against the property, or if there was something like an IRS lien that was placed against the property, then that judicial foreclosure can't wipe those out. But pretty much anything else but those gets wiped out in most foreclosures. So the problem with the pre-foreclosure is that you don't have the benefits of that foreclosure to work with. You're still liable for anything that is on that property. So it's hard to work out deals. And if you could work out a deal, it's, it takes special circumstances, I think, to work it out, because most properties are going to have more junk attached to them than we would really want to deal with, unless it was after, or unless it was like through the tax deed sale, where the properties have just gone through that foreclosure. Otherwise everything basically sticks. And when it comes to those other liens, things like a municipal lien, even those things are not necessarily a problem as long as we can account for them, as long as we know about what they are. So if we're looking at information on this property, and we can see that there were things like there was a mortgage against the property, I'm not worried about a mortgage against a property if it's been through the foreclosure process. That's not going to concern me. If I see some kind of municipal lien placed against the property, if they have something placed, for instance, maintenance lien. Maintenance liens are pretty common, and they could place that lien because, let's say, nobody's living at the property and the weeds are growing, and so they end up cutting the weeds down a couple times a year, and there's a a $600 lien against the property for that. I don't mind those types of liens because first off, I guess as long as I account for them, I don't mind them. You know, if I know that there's that amount, then I basically just include it into the overall amount of the investment. But if I don't know about them, then they're a concern for me. You know, it's not a big deal. If I know that there's an IRS lien that's there, that's not really a big deal if I know about it and if I'm planning on it. But if it's not there, then it's a problem. You know, if I didn't know that it was there, then then it's a problem. So I want to be able to check for those things. Also, I want to know about things like potential repairs, depending on whether or not I'm investing in raw land or I'm investing in something with improvements. I may need to have a visual inspection of the property. Whether I have somebody else go and look at the property for me and send me images, or whether I'm there myself looking at the property. You know, we need some kind of visual inspection when there's a property with improvements. And that's because, again, there's increased risk there. We can't go off of old images. I can't tell you how many times, you know, you look at, I've seen properties that you might think are there, but in reality they're not. You know, it happens all the time with homes. You know, you might look at something and see and think that it looks great, but only a visual inspection is going to tell you, you know, the property was torn down. Sometimes we've been able to determine that stuff using satellite images, but again, that's part of what comes with the territory of investing in properties with improvements. You know, the improvements, improvements complicate the investment dramatically, okay? If we're just talking about raw land, then raw land, you can certainly buy raw land sight unseen, just because there's only so many things that can go wrong with the property. You know, if you're talking about just buying, you know, plots of land, though, you don't necessarily have to have a brand new image of that. It's still a good idea to try to get an idea of what the condition of the property is, but not like it is with improvements. So improvements, if there's improvements that you're with the property you're looking at, then the number of things you've got to know go up dramatically, because then you need to know more than just you know, the improvements. You've got to know what kind of condition they're in and whether or not there are repairs that are necessary or needed. And then you're going to need to have kind of an estimate on, I mean, if you want to do that, if it's part of what your exit strategy is. You know, your exit strategy is a big part of it. Maybe your exit strategy is to just unload it wholesale to another investor who will deal with all of that stuff. You know, if that's your strategy, then that's okay. You can come up with a maximum bid based on what you know you can sell it for. But yeah, it certainly makes it much more complicated when there are those improvements. Something else we're going to look at is, what does the ownership history look like? How difficult is it going to be to obtain a warranty deed on this property? That's one of the things we're going to want to know. And the way we can determine that is to look at the different times in the past where the deed has transferred ownership. Okay, what we want to see there, or I guess what's beneficial there, is if we can look at the ownership history and we can see that the last time that the ownership was transferred before it was foreclosed on here as a deed was as a warranty deed in 2002. That's an excellent ownership history because we're basically looking back to the last time the property had a warranty deed. That's what we want to know when we're looking at you know, the ownership history and we're wondering about quiet title. And that's because if we can go back and see that there really haven't been any transactions since the property had a warranty deed, that's going to be easier to have that quiet title action performed on than a property that has, let's say, been transferred several times between people using quitclaim deeds. Okay, which, you know, you'll come across that sometimes, and that doesn't necessarily disqualify a property or mean that it's bad, but what it does mean is that obtaining quiet title on the property could be more expensive and it could take longer because you know, the property has changed hands more times. There will be more notices that have to go out for the quiet title on that quiet title action. So you know, that's one of the things that we're always going to look at on properties, especially properties if we're thinking about potentially taking it through to get clear title on it, to get a warranty deed on any of these properties. That's something that they're always going to be looking at. We're going to want comps on the property. We're going to want 3 good comps, and we may want or need a title report on the property as well. So all of those things would play into determining what the maximum bid for the property is going to be, but there are a ton of additional concerns that we have if the property has improvements, if we're dealing with tax deeds versus if we're just looking at tax liens. So why don't we take a look at some of the stuff out there right now, some of the examples that are out there, so that I can go through some of these different aspects of the processes we're looking, and so that we can talk about some of these different aspects here of due diligence, when we're looking at a list. So let me switch this over. There we go. Okay. All right, so first, let me just start off here so we can kind of start at the base here of the website. Now, if people have a specific preference, we can actually we can look if it's in liens, deeds, if it's online auctions or over the counter. But what I'm thinking we do here is I'd like to start off using the lists that are available here, some of the services, to go through and look at some examples of stuff that's coming up. In fact, why don't we take a look here? In fact, yeah, well, you guys, if anybody has any specific questions, you can type those in, and in the meantime, we'll start looking at some things like, let's say we can take a look at some online auctions. Take a look at some of the, we've got online tax liens, online tax deeds that are available, and there's a lot of sales that are taking place right now. When we're talking about online auctions, some of the primary companies that we're talking about here are usually companies like Real Auction, Grant Street Group, bidforassets.com. Those are just a few of the ones, and there are many more than that. So if you are not familiar, my guess is that most people are probably going to be familiar with the Real Auction style. That is where we're looking at most of the online auctions that take place, or I would say a good chunk of them are done through Real Auction. So if we were looking at now, let's say somebody here is interested in getting started and they wanted to buy a tax lien to begin with. You can buy over-the-counter tax liens, and Real Auction makes it really easy. In fact, if you're interested in over-the-counter tax liens, basically we go through the same process here of going to the online auctions for tax lien section, and we've got the over-the-counter lists in the over-the-counter section. But the actual link, if you wanted to go directly to the page where they have these over-the-counter liens with Real Auction, you can use here. And so we could click on any of these if we wanted, and they'll tell you if they have county-held certificates. That's their term for over-the-counter. So if we wanted to, I think they've got the actual instructions right there. Let's preview and see if they still have. And they still have over-the-counter available. In fact, this particular county's got 5,000. I've seen other counties that have got a lot. But what we're looking at here are over-the-counter tax liens. And so let's say we can separate these based on the amount, which is usually one of the first things that we'll do. We can also see if they're active here and what year we're looking at. Part of what I'm interested in when I look and see the multiple years here is first, the oldest ones you're going to come across. Stuff that's back to 2010, 2009. When it starts to get that old, we're talking about properties that have been sitting on the books for a long time, and they're probably going to have complications with the property because it's possible that this could be just one lien that's owed on the property, and the rest of the time it's clear, but chances are there's going to be other things that are owed on the property. So if I were looking, let's say, I would normally probably target something a little bit newer unless I was looking for something specifically older. Let's look at something weird. Okay, this one right here is for 2006. You can see here the tax year, certificate year. So let's take a look. Actually, let's go down just a little bit in the size. All right, so if we're looking at one here, we've got a $1,700 lien. Let's take a look. It's for tax year 2015, certificate year 2016. And okay, so $1,700 lien. What would we want to know about it, right off the bat, and how would we be able to determine here whether or not it would be worth buying? Well, some of the first things we'd want to know would be the lien to value ratio. Is the property, is the lien placed against a property that has significant use and value? Well, this property, it's actually going to be questionable. And that's because right off the bat, I can tell there's a problem because the estimated value, the assessed value on the property is about $10,925, $11,000, and we're talking about a $1,700 lien. So immediately it tells me there's something wrong here. If that lien, one single lien is roughly 17% of this property's value, nearly 20%. That would automatically have me looking at other things. But if we wanted to know maybe why, we could take a look and see how the year-to-year breakdown works here with the property taxes that are owed. And so maybe we could look and we could see the value here, historical value and tax benefits. So we can see the assessed value for the property. It's kind of interesting how they've done that because they've got the market here. We can see it's gone from about 2,700 up to about 3,600 is what they're saying the assessed value is. They're saying that's 10% of the value. So they're saying it's worth 30,000. I would want to know more than I'd want a little bit better assurance than that before I'd make any kind of decision on this one. Now, what I would want to see here is annually what's been paid and what's owed. And let's take a look here at this. Now, also, we're talking about the ownership history here, and some of the tools that are available. If I'm looking at the ownership history here, I can see that the last time this property had a warranty deed was in 2004. And in 2004, it sold for $71,000. Now, that was actually with improvements. And the property might be different here. In other words, they may have, I'd have to look and see here if they subdivided it so that I can see what happened exactly after this, because at $71,000, the property may have been bigger than at the time. This was, so we're talking about 2004. We've had 2 transactions since then, and they were both done using a quick claim deed for $100. So they were basically gifted. And the one thing I might be interested in if I was looking at this is to see whether this sale for $71,000, if it was for the same property or not. In other words, what exactly does the property look like now? And at the time they were selling it, were they selling it with improvements like some kind of a structure on it? All those things so far would probably scare me away from the property just because I don't normally perform that much due diligence on properties that show initial problems like that. I would usually move on and look at something else, at least with liens. If there were deeds that we were looking at, then I might dig into it more. But when I start to see a lot of red flags, I just basically move on to another one because there's so many other properties that would have more value. It's interesting. Okay, so looking right off the bat here, and they have the assessed value here about the same. Now, this county may be using that 10% number. They may say that, that the value on it is quite a bit higher. Let's take a look at, they're putting the value. Okay. Something else you want to look at too when you're looking at properties is how much the annual taxes are. But right off the bat, we can see that this is a home. Let's see what we can see about this property. We can see that it's sitting on 0.15 acres. That and we've got a physical address here for the property. Actually, okay, so they say it's vacant residential is the way that it's listed now, but they still show something here. So one of the things I'm wondering here is if this property has had improvements, if they tore it down. And one of the ways we'd be able to determine that is if we looked at a satellite image here of it. Because they'll normally, if a property like this, it shouldn't be listed as vacant residential if it still has a livable structure there on the property. But if they tore it down, then it would have gone from being improved to now being considered vacant residential. Oh, too bad that's not working. There we go. Okay, good. Now, this actually gives me a bird's eye view of the property here. Let's see what that other record pulls up here and shows us. Okay, so what can I see here about this property offhand? You know, the structure very well may still be there. And let me see if I can grab that physical address and take a look. You know, they actually, okay, so no longer has a regular physical address. Basically what we'd have to do on this is track down the physical address, which tells me that I don't think the improvements are still there. So let's say we were looking for something with improvements. Let's see what else these are. Yeah, this one may not be too bad. We're talking about $1,000 here, a little bit over that, $1,200, and a little single-family home. Again, they've got it listed as vacant residential. And let's take a look and see. And we're looking for 41 South Hudson. Okay, so that one right there is 40. So we know it's going to be here on the other side of the street. I think it's going to be this property right here. Or if it is vacant residential now, it could be this lot right here in the middle, which I think is actually what we're looking at. So this probably used to have some type of improvement on it, you know, whatever this was, and they ended up tearing it down. I think we're looking at this lot right here. Let me just get ahead here so I can see if I can spot an address here on this one. I'm pretty sure that's it anyway. So on these ones so far, I would be hesitant on these because if I'm going to spend that kind of money for a lien, I want it to be on a lien against property that has improvements. But it also probably explains why all of these are still sitting on the books. You know, some of these, and the longer they're sitting on the books, the worse it is because as they sit on the books, the taxes and penalties just continue to increase. And so you know, what I would probably do in this case is I would start looking at a little bit lower priced deeds, over-the-counter liens. So I might jump down to a $500 mark, and I would start looking for properties that had significantly more value. If I wasn't finding what I wanted here at this price range. What I think we're finding here at this price range here are right around $1,000, $1,200, $1,500 are properties that used to be homes, but that were torn down that are now just vacant land. And so I think that's the majority of what these are. I might look more specifically for something like vacant land that isn't priced quite as high. So I would look at vacant land that might have similar assessed value, let's say around 10,000, but that I could pick up for a lot less because I'm trying to improve that overall bid to value ratio on these. Now, if there were deeds that we're looking into, then we can start to dig into each one and spend some time on them if they seem like they might fit with our investment strategy. And if we're looking at them over the counter, we're probably going to have to do that anyway and spend some more time on the over-the-counter stuff. The over-the-counter stuff, I think there's a lot of good opportunity there, but it's also more time intensive because you've got to spend some time digging through records. You've got 5,000 potential investments there in that over-the-counter database we're looking at here, and so I think it's a matter of finding the best within that list. You're going to deal with a lot more junk when it comes to over-the-counter lists, generally speaking. So, guys, I feel like I've been rambling here forever. I hate doing these webinars without Steve because it's nice to get his input and have him jump in, but hopefully he'll get feeling better here. Keep an eye out. I'm going to get the information about the new coaching that's up on the website here right away. I'll get this recording that's up and available. Also, if you have questions, feel free to get those over to us. You can usually contact us pretty quickly by email, or you can also call in if that's what works best for you. But email and text tend to be the fastest ways to get a hold of us. So we'll get this up and available. If you do have any questions here, feel free to let us know on those, and I'll get back to you on any of those questions. So I'll send those over, and I'll see if I can get back to you here tonight. Thanks everybody again for joining us here, and we'll see you soon.